Welcome to another episode of Living Fire. Subscribe now so you never miss out on any of our latest uploads. Well, let's get into the video. If you're watching this, chances are that you already know the secret to building long-term wealth. You don't need to earn a high salary or buy the right crypto at the right time to achieve financial freedom, although those things certainly don't hurt. Rather, the simple secret is to get rich slowly. Thanks to the power of compound investing, if you can invest just $10 of your paycheck each month, you'll have nearly $1,500 in 10 years and $8,300 in 30 years with an annual interest rate of 5%. If you can double it to $20 each month, you'll have over $50,000 by the time you retire. Now, we were all hoping for an amount much larger than that, but this simple mathematical fact can help inspire you to do more, even if it means starting with very little. But how should you invest your money? If you can only stash away a few dollars per month, where should you put it so that it grows quickly with minimal risk? Let's dive in to how to start investing with little money, active versus passive investing, and which one's right for you. To start, it's important to know that there are two types of investing, active and passive. Active investing is when you take a hands-on role in managing your investments, often on a weekly or even daily basis. You're essentially your own portfolio manager, buying, selling, and trading stocks with the goal of seizing market opportunities and beating the performance of an index fund, i.e., beating a passive investing strategy. Day trading is the most active form of active investing. Passive investing is the fire and forget strategy that most people and even professional investors follow. It involves picking the right investments once and simply holding on to them for the long term. Passive investors may move things around once or twice a year, but by and large, they let their portfolios age and mature without regular manual intervention. That's one reason why at Investor Junkie, we focus on following a simple yet effective wealth building strategy that even professional investors like Warren Buffett follow. All 6 of the investing strategies on this list take less than 30 minutes to set up, and some are less than 5. So without further ado, let's talk about how to start passively investing with little money. Number 1, use a micro savings app. A solid first step to investing with little money is to open a micro savings account. A micro savings account is the same as a regular savings account, but with lower barriers for entry. Regular savings accounts often have requirements like a $500 or higher initial deposit, a daily minimum balance requirement, limited monthly withdrawals. Worst of all, if you breach any of these account requirements, you could be subject to fees that could wipe out all of your hard-earned interest in a flash. Thankfully, banks that offer micro savings accounts seem to better understand that fees and thresholds kind of defeat the whole point of having a savings account in the first place. Chime, for example, has a daily minimum balance requirement of just $0.01 and will never charge you a fee. The other advantage of a micro savings account over other forms of investing is liquidity. You can typically withdraw from a micro savings account up to 5, 10, or even unlimited times per month. So it's a good place to keep an emergency fund. By contrast, withdrawing from your stock portfolio requires you to sell off shares, incurring trade fees, capital gains taxes, and in the case of your 401k, additional penalties. Although micro savings accounts are essentially risk-free and liquid, the chief drawback is that they don't earn much money. According to the FDIC, the national average interest rate for a savings account is a pithy 0.06% APY. And although it's easy to find a micro savings account offering 0.50%, that's still well below the rate of inflation. Number 2, enroll in your employer's retirement account or open a Roth IRA. You might be surprised to hear that the smartest investments you'll make in your life, the ones that'll accelerate your financial independence, are often the dullest sounding on paper. Perhaps the smartest money move you'll ever make is to opt into your employer's retirement account. There are several reasons why it's a no-brainer. 401ks are extremely low risk. They generate a reliable 5 to 8% returns annually. You can make pre-tax contributions, meaning you only pay taxes on them when you withdraw at retirement, and you're in a lower tax bracket. Your employer will match your monthly paycheck contributions up to a certain percentage, typically around 3%. This is basically a 3% raise. Now, how much should you invest into your retirement account? Number 3, invest with a robo-advisor. The term robo-advisor probably conjures an image of an animatronic Jordan Belfort picking stocks for you. While robo-advisors haven't quite taken physical form yet, they are essentially AI-powered portfolio managers. For decades, We've relied on human financial advisors to invest and multiply our money for us. And while they generally do a good job, Jordan Belfort notwithstanding, human wealth advisors still have to earn a living and occasionally go to sleep. AI advisors don't. So how does investing with a robo-advisor work? When you sign up with a robo-advisor like Betterment, the program will ask you for the same basic info that a human financial advisor would: your age and personal information, your investment goals, e.g. buy a house by 2025, your risk tolerance, your investment account preferences, e.g. no international stocks, focus on bonds, etc. Then the AI goes bleep bloop and chooses the ideal portfolio to match your goals, tolerance, and stated preferences. And in many cases, these portfolios aren't 100% bespoke for each client, but minor variations on existing portfolios that the AI or its human overlords have already designed for high performance. Most robo-advisors can also perform automatic portfolio rebalancing. If you change up your investing goals, increase your risk tolerance, or simply want to tighten up your portfolio, you can do all three in just a few short clicks. A human financial advisor might need a day or two to see your message and then manually readjust the portfolio. All in all, hiring a robo-advisor is a convenient, affordable, and accessible way to maximize a passive investing strategy. Whether you're investing in an IRA or a more aggressive midterm portfolio, they're not a 100% replacement for a human advisor who can better understand your personal goals and guide you with a human touch, but they are an undeniably cheaper and more convenient place to start. Here's the pros. Removes all the guesswork from investing. Why risk choosing your own stocks and exchange-traded funds, ETFs, when you can have a highly sophisticated AI do it for you? They're nearly free. Robo-advisors can charge as low as 0.1%, which is just $1 for every 1,000 invested. This is virtually negligible as far as management fees go. Automatic portfolio rebalancing. With a single click, or even on an automated schedule, you can have your robo-advisor tweak or tighten up your portfolio to stay zeroed on your investment goals. Cons. Flexibility may be limited. Depending on which robo-advisor you go with, you may not have much input regarding which stocks and ETFs you're investing in. Minimal initial deposit requirements. Some robo-advisors require an initial deposit amount of $500 or more to get started. Can't replace the human factor. While some robo-advisors do offer a la carte access to human financial advisors, you may not get all the benefits of building a long-term, one-to-one relationship with a human-led firm. Number 4, invest in commission-free index funds and ETFs. Many investors, especially passive investors, prefer pouring their money into ETFs and index funds over individual stocks. Exchange-traded funds are like big bundles of stock, bonds, or other commodities that trade in shares just like regular stock. A single ETF can contain anywhere from a dozen to several hundred individual stocks. So buying shares of that ETF can instantly grant you broad and diverse exposure. ETFs lend both convenience and diversity to your investment account, and they're always connected by a theme. There are blockchain ETFs, space technology ETFs, and even ETFs that follow the specific shopping habits of millennials. Index funds are ETFs that track an entire market index. For example, there are index funds designed to mirror the overall performance of the S&P 500, the Dow Jones Industrial Average, and other indices. When you buy shares of the ever-popular Vanguard 500 Index Fund ETF, or the VOO, you're quintessentially investing in the S&P 500 as a whole. Here's the pros. Convenience. ETFs and index funds enable you to invest in dozens and sometimes hundreds of companies at once in a single click. Stability. Due to their inherent diversity, ETFs and index funds provide more long-term stability than most individual stocks. Strong performance. While stability and performance seldom go hand in hand, index funds are the exception. S&P 500 index funds famously provide a steady 10% APY in average annual returns over the long term. With commission-free trading, a small amount is not a hurdle to starting out in the marketplace. Cons. Still subject to market conditions, no stock market investment is immune from losing value or even crashing. Not actively managed. Most ETFs are designed once and cast into the market. They are not actively managed like a mutual fund. Number 5, invest in target date mutual funds. Remember back when your robo-advisor asked you about your investment horizon, aka when you plan to sell your holdings and cash out? Why does that matter? Well, your horizon can make a big difference on what investments you make or are made on your behalf. Generally speaking, there are 3 investment horizons. Short term, under 3 years. Medium term, 3 to 10 years. Long term, 10 years or longer. The shorter your horizon, the less risk you want in the portfolio. After all, if you're planning to cash out soon to buy a house, you don't want your down payment money in a risky portfolio that loses 30% of its value right before closing. That's why target date mutual funds can be extremely effective if you have a specific horizon in mind. These specialized funds dynamically lower their risk over time until investors like you can exit with a safe, predictable amount of cash. In that way, target date mutual funds are like trains. They have a human conductor and a predetermined stopping point. So everyone who wants to go there just hops aboard, relaxes, and exits when the time is right. For example, the Vanguard Target Retirement 2025 Fund currently has less risk in the portfolio than the Vanguard Target Retirement 2055 Fund. The passengers of the former are about to disembark, so the conductor is reducing speed or reducing risk in the portfolio. If you like the security of knowing that your investment, however small, is being actively managed with your horizon in mind, target date mutual funds are a safe, smart option. And here's the pros. One and done investment vehicles. Many investors consider target date mutual funds to be reliable one-stop shops for all the money they'll need by a certain date, better tailored to your investment goals. Target date mutual funds dynamically adjust their risks to ensure a smooth exit from your investment. Active management. Although mutual funds don't automatically, or even often, outperform index funds, the comfort of knowing your money is being actively managed may be worth the performance trade-off. Cons: high minimum investment. Many target date mutual funds, such as those curated by Vanguard, have a minimum investment of over $1,000. More expensive. Target date mutual funds have higher expense ratios than passive ETFs to help cover the costs associated with actively maintaining them. Number 6, buy fractional shares of stock. All this talk about retirement, index funds, and other safe, sensible forms of investing. Is it really so wrong and reckless to buy individual stocks these days? Not at all. And even with a small amount of capital to start, it's actually better to have a diverse mix of investments. For example, you can have a medium risk portfolio that's 50% index funds, 25% ETFs, and 25% individual stocks. Or you can have your robo-advisor handle the bulk of your wealth and keep 10% in a YOLO fund that you put in high risk, high reward investments. So let's say you have $50 in your YOLO fund and want to buy shares of a highly speculative stock like Tesla or TSLA. However, Tesla trades at $1,088.47, so it'll be a minute or two before you can afford to buy even one full share. Thankfully, most online brokerages like Public will now let you buy fractional shares. With $50, you can buy 0.046 of a share of Tesla, and your fractional share will entitle you to the exact same benefits as a full share, just on a smaller scale. You can even sell a fraction of your fractional share. So while fractional shares are convenient, they're no less risky than full shares, because buying individual stock is the riskiest investment you can make in the stock market, because a single company's share price can fluctuate wildly on a short and even on a long-term basis. There are simply just too many variables to predict tomorrow's share price, which is why many investors prefer the diversity of ETFs or index funds. Even still, allocating a small portion of your portfolio to hand-picked stocks can not only be exciting and educational, they can be highly rewarding. And with that, we've reached the end of this video, all about how to start investing with $10. If you enjoyed it and you found it helpful, don't forget to give us a thumbs up and subscribe to our channel for more content just like this. Thanks for watching, and we'll see you in the next one.